Good afternoon, everyone, and thank you for joining us this lunchtime for this webinar on navigating the FCA's guidance on non-financial misconduct. My name is Sona Ganatra, and I'm the Joint Head of our FS Regulatory Practice here at Fox Williams, and I'm joined by my colleagues Marion Bloodworth, an employment partner who specialises in advising clients in the FS sector, and Sebastian Sayer, a fellow partner in the FS Regulatory Practice. We are also very happy to take questions on the topics in discussion today, so please do drop those into the Q&A box. We may try and pick those up as we go along, but otherwise we will leave a few minutes at the end of this session to cover those. So as you can see today, the aim of our session is to give you an overview on the regulatory landscape relating to non-financial misconduct. We will briefly be covering some of the history and why we've got here today and what the current landscape looks like for non-financial misconduct. Sebastian will then be talking through the rule changes that have been proposed and will come into place on the 1st of September this year. And Marion will then pick up about some of the practical judgment calls that now will need to be made by all aspects of regulated firms and the practical steps that firms will need to take to address those changes and make sure that you are ready for the 1st of September. And so a bit of a brief recap of why we're here today. So in some respects, of course, the concept of non-financial misconduct is not new. The FCA has repeatedly stated that it views non-financial misconduct as conduct that should be viewed through the regulatory lens and not just as a matter of employment law or a private matter since around 2018. But despite this very, very vocal approach that it has taken, firms have really struggled to understand what that means in practice. And the reason for that is that there's currently no legal definition of what non-financial misconduct actually is. And interestingly, the FCA handbook, of course, is silent on matters of non-financial misconduct, particularly in the areas of COCON and FIT, which are essentially the two main sources the firms look to when it comes to assessing individual behaviour. So all firms have really had to go on until now is a series of speeches from the FCA and a handful of enforcement action taken by the regulator, which in of themselves have actually been criticised and in some respects changed by the reviews undertaken by the upper tribunal. So it really wasn't until last year that the FCA first published changes to the COCON and to FIT, and late last year in December, where it actually issued guidance as to what firms should be doing and how firms should implement its approach to non-financial misconduct. So those changes are due to come into effect on the 1st of September this year, and it will really be the first time that we have explicit rules dealing with non-financial misconduct. And the FCA has stated that it hopes that these rules should result in consistency across the sector and give some firms clarity and certainty as to how to proceed when it comes to allegations of non-financial misconduct. And we all know, for those of you that have dealt with such issues before, that it is a very complex and sensitive area, and the allegations can range broadly and can impact lots of people within organisations. So we'll unpick some of those rules and whether they are actually fit for purpose later on in this session. So who does this guidance and the new rules actually apply to? So it's important to remember that non-financial misconduct and the changes to COCON and FIT only specifically apply to firms with a Part 4 permission under FSMA. So firms such as payment services firms or e-money providers won't be caught by the new changes, but of course, those firms will have an interest in understanding the direction of travel and may want to implement them on a voluntary basis in any event because of the way the regulator is looking at these issues. And the other important factor to remember is that it doesn't just apply to a firm's employees. The concept of who those firms and these issues apply to is much broader than that. And so even individuals that are operating under a consultancy arrangement or providing other services to firms, and not just the part of the firm that is conducting the regulated activity, could also be caught. So for the first time, we do have these rules and they have a much broader application than one would normally understand and anticipate under employment law. So I'm going to hand over to Seb now, who's going to take you through some of those rule changes.
Thanks so much, Sonna. So, what are those changes that Sonna's introduced? Well, there's changes to the guidance and there's one rule change. And it really, for the first time, introduces a regulatory definition of non-financial misconduct. And you can see that in the black box with the yellow text on the slide. And what we're really talking about here, to paraphrase, is bullying, harassment, and violence. Now, the handbook changes make clear that those things will now be breaches of Individual Conduct Rule 1, so the obligation to act with integrity for individuals, or Individual Conduct Rule 2, the obligation to act with all due skill, care, and diligence. So let's have a bit more of a look at what that means in detail. So, scope of COCON. The FCA, in their finalised rule and guidance, have confirmed that the new COCON rule expands the scope of COCON as it relates to non-financial misconduct in non-banks to align with the position in banks. So what this means is that non-financial misconduct towards colleagues will be within the scope of the conduct rules if it occurs in relation to the performance of the individual's role. So it will no longer be restricted to conduct that forms part of or is for the purpose of financial services activities. And the FCA says that this approach is intended to align and promote a more consistent application of the rules across financial services. What is slightly more complicated is where firms have sections of their business which don't at all deal with financial services. And so if that applies to your business, then certainly the guidance is worth looking at fairly closely. Because sometimes non-financial misconduct is going to be excluded from regulatory capture in those cases. And in some cases, it will be complicated. The FCA has added in a table of scenarios to show how the exclusions potentially apply. For example, one of the exclusions relates to staff in a shared function where certain individuals deal with the financial services business and others deal with non-financial service business. And what the FCA says is that conduct is going to be in scope of COCON if either the perpetrator of the conduct or the subject deals with the financial services business of the firm. So you're going to have to very closely look at that if, for example, someone works in a joint HR function and they're dealing with someone that doesn't work at all in financial services within the business. The FCA has introduced an extensive flow diagram, which is kind of helpful, on questions who, what, and where, so which will help firms determine whether COCON applies at all. The next point is its application to banks. So the FCA have confirmed in their guidance that the new rule is relevant to banks, even though the scope rule change doesn't apply to them. This is a bit of a fudge by the FCA, but what it says is that the new rule should be applied by banks as guidance, which really means that the banks can and should use the guidance to determine whether conduct, which can be described as bullying, harassment, or violence towards a work colleague, is a breach of Individual Rule 1 or Rule 2. Finally, there has been, as someone mentioned, more alignment between the regulatory position with the employment and equality law position, and that includes terminology. So, as you can see on the slide in the box, the purpose of the conduct is as important as its effect. So what this means is that an individual can breach COCON even if their hostile and intimidatory communication is intercepted before it reaches the intended subject. So I think that probably most commonly applies in an email situation where someone sends a horrible email to a colleague and it's picked up by a filter. In that case, even though it doesn't reach the person, that person can still have breached COCON because the purpose of that email will have been to commit non-financial misconduct. And you can see that the FCA really uses bullying and harassment as shorthand terms to describe unwanted conduct that violates a colleague's dignity or creates an intimidating, hostile, degrading, humiliating, or otherwise offensive environment. And through the consultation process, there was a fair degree of pushback on this, and various firms and participants in the consultation wanted the FCA to define non-financial misconduct more narrowly, but the FCA resisted that, and so now we're left with a fairly wide definition. Some other key points as it relates to COCON from this session is that there is still a lot of judgment here for firms to apply. The FCA has tried to be helpful. It's listed in its guidance non-exhaustive factors which firms can use to assess seriousness. So these include things like whether the misconduct is part of a pattern, the duration of the misconduct, the impact on its subject, the relative seniority between the perpetrator and the victim, and whether that conduct could justify dismissal or is indeed criminal. But what the FCA declined to do was provide definitive examples, and it has explicitly said that firms are best placed to assess seriousness in individual cases. So it's clearly a key area of judgment for firms. But what we would say is really important is that it's crucial for firms to record their decisions, seek advice, and take a measured, justifiable approach on those borderline cases where it's arguable whether it's serious misconduct or not. Because the FCA has said that it will consider a firm to be complying with its rules so long as that judgment is reasonable. And as with all things with the FCA, if you're not able to demonstrate, probably in writing or through a document, what you've done, then it'll be much more difficult to convince the FCA that you've taken those kind of considerations. The FCA have said in the guidance that minor incidents that do not have the purpose or effect described in the rule, i.e. violating someone's dignity, being degrading or humiliating, will not breach the FCA rules. So again, the purpose and the effect are crucially important factors for firms to consider. The boundary between work and private life. So this is always a key area of consideration for firms and advisors to look at. The FCA's guidance has given examples of where conduct outside of the office may be sufficiently closely connected to work to engage COCON, and it is certainly worth having a look at those examples and the table set out in the guidance. So, for example, misconduct at training events, award ceremonies, and workshops organised by clients. The FCA suggests those come within the scope of COCON. There are some easy examples and then some more challenging ones. So the FCA says that misconduct by a person in relation to a co-worker while both on the firm's premises is within the scope of COCON. It feels straightforward enough. Similarly, misconduct by a person in relation to a co-worker at a social occasion organised by the firm is within the scope of COCON. However, misconduct by a person in relation to a co-worker at a social occasion organised in their personal capacity, the FCA says is generally not in the scope of COCON. However, if, for example, the event is organised by a manager, then it may fall within the scope of COCON because junior people may feel that they have to attend because they've been invited by a manager, in which case it could bring the whole event within the scope of COCON. And always more problematic, the after party. So the FCA's guidance explicitly says that if an event takes place after a firm event, but at a separate location or venue, it may still fall within the scope of COCON if it's a continuation of the first event, or if the conduct started at that first event and continued at the new venue. So that is going to be really fact specific and probably quite a grey area. So certainly one to look at pretty closely. Manager accountability. I think this caused some degree of consternation through the consultation process, but the FCA has clearly said that managers can potentially themselves breach COCON for failing to prevent non-financial misconduct. The FCA hasn't defined the term manager, as it says that meaning will vary from firm to firm, but what it made clear is it's not talking about just senior management function holders, and it's not even talking purely about line managers either. What the FCA have said, however, is that a manager will not be responsible for failing to prevent non-financial misconduct if they couldn't reasonably have known about it, or if they didn't have the authority to act to prevent it. So it's a kind of reasonable steps argument that we've seen in relation to SMFs for some time. So what could those reasonable steps look like? Intervening to stop inappropriate behaviour, taking complaints seriously, and generally providing a safe environment for raising concerns. However, if a firm feels that a manager could have done more to prevent non-financial misconduct, then potentially they are going to be in breach of COCON, and it's probably most likely Rule 2. Self-reporting, this again was an issue throughout the consultation process, and where the FCA have landed up is that they have amended Senior Manager Conduct Rule 4, which requires senior managers to disclose information of which the regulators would reasonably expect notice. And what the guidance says is that it makes it clear that the senior managers will have to proactively disclose information about their private or personal life under Senior Conduct Rule 4 if it would be relevant to an assessment of either their fitness and propriety or COCON. So again, it's a judgment for managers personally to make. What we've just discussed is the impact on COCON, but there have also been revisions around the FIT section of the FCA's handbook. So COCON applies to pretty much all staff within the financial services business, but FIT applies to the more senior staff, either those who have to be approved by the regulator or those who are certified by their firms. And the changes have largely been mirrored from the COCON section. So what this now says is if someone commits non-financial misconduct at work, that will certainly be relevant to fitness and propriety. There are nuances within the guidance. So investigating unproven allegations about private life. The guidance in the FIT section now makes clear that firms aren't expected to investigate trivial or implausible allegations about private life, or those that would be more appropriate for relevant law enforcement or other authorities to investigate. And the changes make it clear that firms don't have to look into allegations that, even if true, wouldn't be relevant to someone's fitness and propriety. However, conduct in private life is going to be relevant to someone's F&P if it shows a material risk, and it's that term, a material risk, that's important, that an individual will breach regulatory requirements. The FCA makes clear that a material risk is one that's more than simply remote or speculative. So conduct in private life that would breach regulatory standards if repeated at work, for example, violence or sexual misconduct, will be relevant to someone's fitness and propriety. The FCA have said that it shouldn't automatically be assumed that it would be repeated at work, but it's going to be a key area of judgment and probably difficulty for firms to look at. There's a question around reporting obligations as it relates to fitness and propriety and some of these types of allegations. There were concerns about the draft guidance, which said that the fact that a firm has not been able to establish the truth of an allegation doesn't mean that a firm shouldn't report it to the FCA if, were it established to be true, it reasonably would be material to an assessment of F&P. And lots of respondents said, well, this is unfair. We're being told we have to report things where we're not even sure that they're true. The FCA have deleted that section, but they also made reference to an existing rule in the subsection of the FCA's handbook, which requires firms to report as soon as possible any information they're aware of which would be material to an assessment of a senior manager's F&P, which includes matters not limited to matters of established fact. So, for example, that an SMF is subject of an ongoing criminal investigation or disciplinary proceedings. So that I think was a helpful change from the consultation for firms. Social media. it's going to become increasingly important, and it's one of the more challenging areas for firms when we're advising clients and talking to firms about this area. The FCA have confirmed in their guidance that firms do not need to proactively monitor an employee's social media accounts. What they have said is that an individual's social media activity will be relevant if it indicates a material risk of breaching regulatory standards. For example, threats of violence, clear involvement in criminal activities, or conduct demonstrating a material risk of workplace harassment or bullying. Firms aren't required to investigate allegations about private life social media activity that would be trivial, implausible, non-material, or irrelevant to F&P, or if the conduct is unlikely to be repeated at work. In the draft guidance, there was the inclusion of the word offensive views on social media, and that's been deleted on freedom of speech grounds. So what's clear is that individuals may express controversial and potentially offensive views on social media without calling their fitness into question. And I think that's all for me, and I'm going to hand over to Marion.
Thank you, Seb. If we could just move, thank you, to that slide. I will come in a minute, as Sona highlighted at the beginning, to some of the practical steps firms need to take, but we did just want to reinforce a little bit, I think, what Seb's already, a point Seb's already made about the importance and impact of judgment calls. Although the guidance is helpful, and we've all been asking for it for a long time, there are still a number of things that aren't said there. And what is very clear is that a lot is going to rest with firms to make judgment calls about this. And that probably in practice means HR, risk, compliance, legal, depending on how serious it is. Obviously, matters may have to get elevated. As you may have known, and this obviously, as Sona says, is not a new concept, but you are acting as a regulator. So it is really important that this is taken seriously and treated seriously. And I just wanted to flag this now because I think as you go through your preparation and your planning for September, that's a point that needs making internally, that all the steps you're taking now in terms of preparation are with a view to putting you in the best possible position for exercising that judgment appropriately, fairly, consistently, and in a way that can be backed up and supported. I think the other thing to say is that you will need to exercise that judgment most of all around the thresholds of seriousness. As Seb has said and Sona said, the FCA are really only interested in serious misconduct for the purposes of it being a regulatory issue. That doesn't mean that it's not an HR issue. It doesn't mean it's not a behavioural and a values issue for you in your firm. But the flip side of that is that not every instance of misconduct, workplace unpleasantness, interpersonal friction will necessarily be a conduct rule issue, nor will it be a breach of somebody's fitness and propriety. So this is where the judgment, what matters to you in your firm, and how you uphold those values will become particularly important. And that's why I'll talk in a little bit more detail in a minute about policy and framework updates. But you want those policies and frameworks to reflect the types of judgment that you make as an organisation. There'll be cases, as Seb said, where you'll need to exercise judgment about whether you pursue a matter that's arisen outside of the office, because you will need to go through the sense checks that he's highlighted about whether it could be material, whether it could impact the person's fitness to do their job. Is it going to be brought into the workplace, or is it a solely personal and private matter? And I think it's also a point at the moment that there are no really substantial public case studies about this. There are obviously the cases that make the headlines, and we've had one relatively recently, but at the moment firms are all having to deal with this themselves internally. And the one thing that I suspect the industry is going to want is a degree of consistency, a little bit like we have called for along the lines of regulatory references. So I just flag that now because this is a time when all those different teams that I've mentioned, legal, risk, compliance, HR, and the business all need to come together and try and get agreed ways of working and agreed approaches to this, not least because there is a concern that the regime could be weaponized or it could be used inappropriately. The whole thrust of this, of course, is to improve culture in financial services firms, and that's what everybody wants to see. But we just do need to be alive that individuals may choose to use it for different purposes. So if we just have a look, if we could move ahead to the practical steps, there's a range of things, and it may well be that some of you are doing this already. I've split these out over the next couple of slides, but The really obvious one, as Seba said, is think about how you will deal with these matters internally. Do you already have policies and frameworks in place, processes that will allow you to deal with those? It may now be that you need to revisit those to make sure that the thrust of the guidance, the rule, for example, is properly reflected in there. And you can use the flowcharts that Seb mentioned to check how you'll apply the rules and the guidance to any particular situation, to give yourself internal rules and processes that you will follow, not least because, of course, sometimes these issues are the ones that blow up suddenly, unexpectedly, after a work event, after a weekend issue, and you need to be seen to be taking action proportionately and quickly. The other thing to flag is that you now need to be very alive to individuals raising concerns. Now, not saying that people aren't already, but what we now need to be conscious of is that a concern that is raised could constitute an allegation of non-financial misconduct, in which case you need to be triggering the kind of processes and policies that I've just mentioned. And a little bit of this is around educating people to be alive to what could be an allegation in the way that we are hopefully already alive at the moment, for example, to a disclosure that might constitute a whistleblowing disclosure or an allegation that might constitute an allegation of discrimination. And in those cases, individuals are protected if they raise those allegations from any form of detriment. And it's that kind of awareness of these issues that now needs to be reinforced and built in. Obviously, the consequences for somebody who is accused of non-financial misconduct can be very serious. And we all act for corporates, but we also from time to time act for senior individuals. And we have therefore seen this from both sides. And what this means is that instances of potential non-financial misconduct, which could result in a conduct rule breach finding or a negative F&P finding, need to be investigated very carefully, thoroughly, objectively, and rigorously, because, as I say, the consequences can be so severe. Now, again, that may be something that already happens in your organisation, but it's worth thinking about how you would react, for example, if an allegation of non-financial misconduct was made against somebody very senior. And it may be that you need to think about how best to investigate that. Does it involve, for example, taking external support on board? Because this is still down to firms and how you choose to treat an issue, as Seba said, the importance of recording how you've reached your decision will also be highlighted here. What process did you follow? How was the issue evaluated? Who made the decision? Who was consulted? What factors were taken into account? So long as you can show what you've done, there's an audit trail, and you can show that you've acted reasonably, fairly, with a proper and thorough investigation. Our view is that that is likely to satisfy the FCA. It is a lot harder to satisfy them if there is nothing to show how a decision is reached. And obviously you will need a degree of governance, you'll need some oversight. You'll want to know how effectively these policies and processes are being implemented and applied. Are issues actually being captured? Are people reporting things? And are managers equipped and able to deal with this? The next important thing, obviously, is how are you reporting this? You need to make sure you capture findings of non-financial misconduct in the way that you capture conduct rule breaches, if your decision is that it is a conduct rule breach. Make sure that those reporting processes are in place internally. And that's where all the thresholds for what constitutes serious misconduct are going to come into play. And again, obviously, this all feeds through into the regulatory reference process, where, again, we've all seen to date the consequences of a finding, which is then reported on a regulatory reference and goes to a prospective new employer. And we've seen some of the fallout when a prospective employer doesn't like the reference that they're receiving from a job applicant, and that can lead to offers being withdrawn. What's most important probably right now is training and awareness raising throughout the entire firm. And that's raising awareness amongst staff at all levels, reinforcing the expectations that you have of them, of the behaviours that you expect to see in the workplace. Obviously, in an ideal world, you're not having to deal with non-financial misconduct at all because allegations aren't made, because people are able to behave properly. But this is the real world, and we know that's not always how it plays out. And you need to equip your managers. They need to understand what their obligations are. As Seb highlighted earlier on, their specific obligations around trying to prevent, as far as possible, non-financial misconduct occurring, and creating the sort of environment where, if it does, individuals feel comfortable and able to speak up. Ideally, they will be able to intervene and deal with this early on. One of the FCA's comments that we cling to, and it won't be news, I don't think, to any of you, is culture risk is conduct risk. And they couldn't be clear. They have been trying to change culture, as we said, in the sector for a very long time now. And this is the way that they're seeking to do it. And if you want a sort of practical tip as to how you might think about how this will play out in future, have a look at a situation you've had in the last, whatever, few months, few years, and test that against the new guidance. Would you have still done the same things? Are there steps that you could or should have taken or would take in the future differently? And that can help inform how you approach this going forward. We're also doing a lot at the moment in terms of board level briefings, training for staff. These are all things that I think, whilst people hear about this, they need to understand what it means in practice. So giving people those practical implications of this, what it asks them to do, what you expect of them at this stage before it all comes in September would be very helpful. And I think so. I'm going to pass back to you at that point just to see if we've got any questions or further observations.
Thanks, Marion. So we have had a few questions in which we've got a little bit of time, so we will deal with. I think one of the first questions, just to pick up on and going back to what we started with at the beginning, is do these rules really bring that level of consistency and clarity and confidence to firms that they know what to do should an allegation of non-financial misconduct come along now or post-September once these rules and guidance are in place? I've got some views on that, but I don't know if Marion, Seb, if you want to jump in first, just sort of on your thoughts and some of the experiences that we've had experiences with our clients recently.
As Sona, you said at the start of this call, this is an issue that we have all been dealing with for some time, and it has always been very difficult to know if you're acting for a corporate where to draw the line. But similarly, if you're acting for an individual, and we have matters where I think firms have referred to conduct, for example, as informing the reason for some of the decisions they've made about the individual, but they haven't necessarily gone through this kind of process that I was talking about. And what that does is leave the individual uncertain as to whether, for example, in the future, the firm would look to refer to that behaviour on a regulatory reference or in any other kind of way. And I think there does still need to be some clarity about whether something does or does not constitute NFM if you are that individual who's been, for example, accused of something, but an investigation hasn't happened or a thorough investigation hasn't happened.
I think that's right, Marion. So my take on it is, these rules do go some way. And look, I stand by the FCA in the sense that this is very difficult. It's very difficult to give clear guidance to deal with every single situation that could occur or allegation of non-financial misconduct. But I think that there is a lot in those rules that, again, leave so much to firms to try and grapple with and understand. And picking up on something you said earlier, Marion, that remember, this is really incumbent on the firms to implement and police as they go through, because really it's the firms dealing with these allegations and dealing with them in the first instance before it ever gets reported to the FCA or the regulator becomes aware of them. So I think that there's still a level of inconsistency that we will probably see. And the real impact on that is, of course, firms will struggle to understand how to respond, and also on the individuals themselves, where, as you say, Marion, there could be a circumstance where the alleged perpetrator is left with a decision or regulatory reference that actually they've not had the ability to respond to or really fully understand what thought process has gone behind it, and they can't really appeal against that unless they're willing to take some sort of litigation approach to it, which most individuals won't. So I think it goes some way in answering some of the difficulties that firms have experienced, but perhaps not far enough. And I think we'll have to wait to see how it pans out. Another question that's sort of come through is sort of why has the FCA had to introduce these rules and these prescribed rules in the first place? Were there other rules already in place that could capture these sorts of behaviours? So I don't know if you want to cover that one.
Yeah, sure. I mean, I think it's a fair question, because the rules actually haven't changed. It's the guidance that mainly has changed. So the integrity, as it relates to COCON, the integrity rule has always been there. The obligation to act with all due skill, care, and diligence has always been there. And the examples that were in the previous guidance are just examples of how someone can breach it. So it's always been open to firms to say, actually, someone behaving this way, we do think has breached the conduct rules, or they're not fit and proper. I think fundamentally the FCA doesn't think firms have been doing enough about this. We've seen it through reports that were given by the Treasury Select Committee, the Sexism in the City report, where that body didn't think that financial services were doing enough to address these types of behaviours. I think it's also a continuation of the senior manager and conduct regime. The FCA, the regulators want more individual accountability, and this is a driver towards that. And it's also generally within the kind of ambit of culture that they've talked about for so long. And culture is really about how individuals act. It's not just an amorphous concept. Your culture is perhaps defined by the worst behaviour that you tolerate, and the FCA wants to stamp out that kind of behaviour as much as possible. So I think they've really introduced these to make it as clear as possible that they don't find this kind of behaviour within financial services acceptable.
Exactly. And another question that sort of pops through that I think is an important one is about reporting. Sort of what is it that firms need to report? So if an allegation of non-financial misconduct comes through, do you have to go to the FCA, or is this something that can be dealt with internally? It's an important question because there has been a real lack of clarity, and Seb picked up on some of this in the section that he covered about what firms have got to report. And I think the position now is clearer, in the sense that, if an allegation of non-financial misconduct is raised within the firm, and at that stage, it is incumbent on the firm to investigate and assess what has happened. And so this would be looking at reporting to your normal functions internally. It doesn't necessarily create an additional obligation to go to the FCA. One must look at the reporting obligations currently in place, so under SUP, to see if a reporting obligation is triggered in any event. So the example, Seb, that you gave earlier about if an allegation has been made about a senior manager, that may be something that triggers a reporting obligation in of itself anyway, regardless of whether it's a non-financial misconduct issue or not. So again, this goes back to this point around actually this is really on firms, and the FCA is really putting, essentially delegating these decisions down to firms to make, which is where some of these difficulties come from. I'm just going to pick up, just conscious of time, a point around what impact does this all really have on firms? Because we obviously talked about firms having to deal with policing this sort of behaviour and making decisions. But what if a firm doesn't deal with non-financial misconduct properly? What are the risks from a regulatory perspective there? On that, I think it's interesting because initially there had been some proposed rule changes about, do we bring in changes to the threshold conditions? So the FCA looked at whether firms themselves could be held liable if they weren't dealing with matters of non-financial misconduct. And the regulator had made it clear that, non-financial misconduct and not dealing with it does indicate that there are cultural and governance concerns within firms. And I think really that's the key point, that firms must demonstrate, and to Marian's point earlier, be able to demonstrate and record that they have properly dealt with and thought about allegations of non-financial misconduct, so that they can demonstrate to the regulator that as and when these matters arise, that they are dealing with them, they are taking them seriously as an organisation. And even if those decisions mean, there is a whole record of non-financial misconduct allegations that are raised, that they can show that they have taken them seriously and taken action in them. Seb, Marian, I don't know if you want to pick up on some of that as well.
Yeah, I would just add that I think it's probably going to be very unlikely, in very few cases, where there are going to be enforcement cases against firms for not taking action. But what is much more likely, and you won't be able to see it publicly, is if the FCA decides that a firm isn't dealing with these issues properly, you'll face very intensive supervisory activity, weekly, fortnightly calls from the FCA quizzing you about what you've done historically, and how you're going to remediate that going forwards. And I think you can't underestimate the time cost and the management cost of dealing with those types of issues. And it's very difficult. Whereas an enforcement process, there are kind of set guidelines around how it's going to work. Very difficult in a supervisory process like that to manage it. And so firms really don't want to be in a position where the FCA has kind of lost trust with them on this issue, and think that they need to take a much more active interventionary approach.
And Sana, just to add there, it occurs to me that, of course, if a firm does not take non-financial misconduct seriously, and maybe that's indicative of a culture where people cannot raise concerns, or when they are squashed. As we all know, the FCA very much encourages the use of its whistleblowing hotlines, and it is entirely possible that employees who are concerned about that will raise those kind of anonymous whistleblowers to the FCA, and that may be another route, I guess, that the FCA could start picking up if there were themes or high volume of notifications, for example.
That's right, and I think between us, we've seen quite a number of examples of that making their way through to the regulator, and Seb, as you said, that's led to supervisory action, including things like skilled persons reviews being threatened into how firms are actually dealing with non-financial misconduct allegations. So lots of different ways the regulator can pick up on how firms are actually reacting to non-financial misconduct. So I am conscious of time. I'm sorry if we've not been able to cover all of the questions. It is one of those topics that that always raises a number of questions, and we will get back in touch if any of you have questions that we've not been able to answer as yet. I will leave you here with our, if you do want more information, we have a hub on our website. Please do take a look at it. We do update it with various notes and articles that we've produced on this area, and we will be putting in information on there about further sessions that we'll be doing on this very important topic as the year progresses. But in the meantime, thank you very much for joining us this afternoon and for your time. Thank you.